Every financial advisor, every parent, they all tell you the same thing. Save your money. Be responsible. So you do it, you work hard, you build up that nest egg, you put it in a savings account. And then what? You watch that capital get slowly, silently eaten alive by inflation losing value every single day while you wait for the so-called perfect time to invest. But the rich, they're using money they don't even own to get richer. And that waiting, that hesitation, that's the biggest mistake you can make. If you want the real roadmap to stop saving and start owning, you need to be here. This is the Brick by Brick podcast, where we help beginners build wealth through real estate, one property at a time.
And that waiting you mentioned, that's exactly what keeps most people on the sidelines forever. Building real wealth, enduring wealth, it requires a shift. You have to move from just randomly saving to strategic, intentional ownership of assets.
That is exactly our mission for this deep dive. We've torn apart a mountain of material executive course summaries, incredibly detailed beginner guides from platforms like BiggerPockets, and we've sifted through hours of transcripts from some of the sharpest minds in real estate. We're talking Thought Nguyen, Smart Money Bro, Chris Crone, Shalene Shratria. And our goal here isn't just to give you a list of strategies. It's to really distill the why and the how behind building that financial foundation you need as a beginner. We are literally going to build your investment foundation, brick by brick.
Yeah, we're going way beyond the generic advice. We're focusing on the mechanics. There's that famous saying, often attributed to Andrew Carnegie, that 90% of millionaires got there by owning real estate. We're going to show you how to stop trading your time for a paycheck and start turning money that's depreciating into assets that appreciate over the long term.
Okay, let's unpack this then. And I think we have to start not with houses or financing, but with something more fundamental. It's all about mindset.
It's the first and, honestly, it's the hardest hurdle. It's that mental shift around money, around debt, and what ownership even means. All the sources we looked at highlight this massive contrast between what they call the poor mindset and the rich mindset.
And I think most of us, let's be honest, were brought up with that poor mindset. It's what you learn at home. It's what you learn in school. So what does that actually look like in practice for someone who's thinking about starting?
Well, the poor mindset is, it's defined by hesitation, by anxiety about timing. People are always waiting for the right age, or waiting till they're married, or for that big promotion or the big one, waiting until they have enough money saved up to pay cash or make some huge down payment.
So their focus is all short term.
Exactly.
Yeah.
Immediate funds, status symbols, and then when they finally do buy a property, it's almost always a primary home, a flat, or a house. And it's driven entirely by this emotional attachment to my own place. And they do it using up all of their hard-earned cash savings.
So that money is just sitting there. It's dead money. It's ballast in the boat instead of being the fuel.
That's a perfect way to put it. The rich mindset, on the other hand, sees money as a currency. It has to move. It's like a river. If your money is just sitting still in a bank account, it's shrinking. It's being eaten alive by inflation. Historically, that's 3–4% a year. It's a guaranteed loss of purchasing power every single year.
Wow.
So the rich mindset says invest early and view property as an asset to maximize, not just an emotional home to live in.
Okay, this flies in the face of probably the most ingrained piece of financial advice anyone's ever heard. Debt is bad. How do we even begin to square that with the fact that all these experts are actively telling you to use debt strategically?
This is the power of leverage. And what's fascinating here, what's really key, is that even these giant cash-rich companies, think Google, Apple, big real estate trusts, they still use loans aggressively.
Why? If they have billions in the bank, why would they borrow?
Because they understand the game. And the insight is this: inflation works against the value of your debt.
Okay, can you walk us through that in simple terms?
Sure. Let's say you take out a $300,000 loan today.
Yeah.
You're on the hook to pay back $300,000, plus interest, right?
Right.
But the dollars you're using to pay it back in, say, 15 or 20 years, they have way less purchasing power because of that 3 or 4% inflation every year. In real terms, the loan is actually shrinking over time. So if you can use that debt to buy an asset that appreciates, that grows in value faster than inflation, you're essentially using the bank's depreciating money to buy something that's making you richer. Using leverage smartly isn't just okay, it's absolutely essential for real long-term growth.
So just to be clear, I buy an appreciating asset, like a fourplex, with the bank's money. The property value goes up, my tenants are paying down the loan for me, and the debt itself is being devalued by the economy. I'm winning on 3 different fronts with someone else's capital.
Precisely. And that leads to a really important critique the experts have about standard home ownership, especially your primary residence. If you buy a flat for $600,000, put 20% down, take out a 30-year mortgage, what are you really? You're just a tenant. You're the bank's tenant until that debt is paid off.
And the decision was emotional, not financial.
Exactly. If your only goal is to build wealth, buying land or property with high growth potential, ideally using leverage, is by far the superior financial move. You want assets that pay you, not ones you spend your whole life paying off just to feel secure.
That is a really tough pill to swallow. I mean, the whole dream of homeownership is so romanticized in our culture.
It is.
Yeah.
But separating your emotions from your finances, that's the core of the rich mindset.
Okay, so let's say our listener gets it. They accept they need to use leverage and focus on wealth. Where do they even begin? You can't just jump into $1 million deal with zero knowledge.
No, absolutely not. The foundation has to be knowledge and preparation. You simply cannot shortcut the learning process. I mean, this is a field that involves massive financial risk.
The good news, though, is that the sources all agree there's just an incredible amount of free, accessible information out there today. I mean, stuff that just didn't exist 20 years ago.
The amount of education available now is just stunning. A platform like BiggerPockets has, over 3 million forum posts. They have a beginner's guide with 62 free, detailed lessons on everything from analyzing a property to landlord-tenant law. You can find intro courses on sites like Allison, or you can read thousands of articles from people who are actually in the trenches doing this right now.
And what if you're a bit further along, maybe looking to do more complex institutional type deals?
Then you've got specialized high-impact programs. For instance, Wharton has an 8-week certificate program on real estate investing and analysis. It's designed for, mid-career finance professionals. It blends academic rigor with practical modeling skills. The point is, there are quality options for every single level, from a free blog post to a premium executive course. The only barrier is effort, not access.
But before anyone starts playing with spreadsheets, every single source agrees. You have to get your own financial house in order first. Let's talk about organizing the four walls.
Exactly. You can't build wealth on a foundation of chaos. If your own finances are a mess, the stress of investing will just crush you. There are 3 non-negotiables. First, you have to create and stick to a detailed monthly budget. Written down or digital, doesn't matter. You need to know where every single dollar is going.
Okay, that's number 1.
Second, you build an emergency fund. Usually that's 6 to 9 months of living expenses, and it needs to be in a liquid account you can access easily.
And the third one goes back to what we were just talking about, debt.
Yep. You have to eliminate all high-interest bad debt. We're talking credit card debt, payday loans, anything with those crazy interest rates, 15% or higher. That kind of debt has such a high guaranteed cost that it's just an anchor. You can't realistically expect to get returns in real estate that consistently beat 20% credit card interest. Get rid of the bad debt first, and then you can start using good debt with confidence.
So once that foundation is solid, the bad debt is gone, what's next? The sources talk about something that's really personal and often gets overlooked: assessing your risk tolerance.
Right. Risk is everywhere. You can't avoid it. Even holding cash is risky because of inflation, like we said. The goal isn't to avoid risk, it's to understand it and manage it intentionally. Your tolerance for risk is going to dictate your whole strategy. A low-risk investor, for example, might only buy fully rented properties in stable markets. A high-risk investor might be flipping distressed houses or developing raw land.
So what factors into that? It's not just a gut feeling, is it?
No, it's a calculation. It's based on 4 things. First, your financial goals. Do you need cash flow now for retirement, or are you just looking for long-term appreciation? Second, your income stability. Are you in sales on commission, or are you a teacher with a steady paycheck? That matters. Third, your current obligations. A single person can absorb a loss much easier than someone supporting a big family. And finally, your knowledge level. The more you know, the more risk you can safely take on because you know where all the landmines are buried.
And without that clear self-assessment, you're just investing emotionally. You're chasing deals out of FOMO or panic selling when the market dips. And like the experts say, emotion is the most expensive thing on any balance sheet.
Absolutely.
Okay, that sets the table perfectly. So we've moved from the mindset to the strategic blueprint. We have to talk strategy, because just randomly buying a property is a recipe for disaster.
Strategy is your North Star. It's the blueprint that guides everything: location, financing, property type. For example, if your strategy is all about high cash flow, right? You want money in your pocket every month. Well, you're not going to do that in Los Angeles or San Francisco. The prices are just too high. The strategy has to dictate the market you choose, not the other way around.
So you need two things, really. An investment vehicle, the niche, and then the strategy you're going to apply to it. What are some of those vehicles a new investor should know about?
The list is huge, but a beginner should really focus on mastering one or two. The most common niches are, of course, single-family homes and small multifamily properties, which is 2 to 4 units. Then you can move up to large apartments, which is 5 units or more. And what's really important to know here is how they're valued. A 5+ unit building is valued based on the income it produces, not on what the house next door sold for. That creates massive opportunities to add value.
So wait, if I renovate a kitchen in a fourplex, its value is still kind of tied to the neighborhood comps. But if I do that same renovation in a 10-unit building and I can raise the rents, the building's value goes up directly because its income went up.
Exactly. You're in control of the value. Beyond that, you've got niches like raw land, mobile homes, commercial property, even things like tax liens or investing in mortgage notes. But the advice from every expert is the same. Master one or two first. Don't be a jack of all trades.
And once you pick the vehicle, you apply the strategy. Let's break down the three most common ones for beginners.
Okay, the classic is buy and hold.
Yeah.
Simple. You buy a property, you rent it out for the long term. You're building wealth in 4 ways at once. You get cash flow every month. You get long-term appreciation. The tenants are paying down your mortgage principal, and you get huge tax write-offs like depreciation. It's the most consistent, stable way to build wealth over time.
Then you have the total opposite, the fast-paced, high-risk world you see on TV. Flipping.
Right. Flipping is all about buying cheap, fixing it up, and selling it quickly for a profit. And the absolute key here, the rule you can't break, is the 70% rule. It's all about risk mitigation. Your purchase price should not be more than 70% of the after-repair value, or ARV, minus your rehab costs.
Let's run those numbers. So if a house will be worth $400,000 when it's all fixed up, and the rehab is $50,000.
Then 70% of 400K is 280. Subtract your 50K rehab, you can't pay a penny more than $230,000 for that house.
Why is that 30% buffer so important? It seems like a huge margin.
It seems huge, but that's what protects you. That 30% has to cover all the hidden costs. Things like agent commissions when you sell, that's 5 or 6% right there. Closing costs, title fees, and the big one, holding costs. That's your loan payments, your utilities, your insurance. For the 6, 9, 12 months, the property is empty while you're working on it. And that's your buffer for when you open up a wall and find a huge surprise. Speed is everything in flipping because every delay just eats away at that profit margin.
And the third strategy, the one that avoids ownership entirely, is wholesaling.
Wholesaling is basically being a deal matchmaker. You find a great, deeply discounted property, you get it under contract with the seller, and then you sell that contract to another investor, usually a cash buyer. And you get an assignment fee for doing that. It could be $500, it could be $5,000, sometimes even more.
That sounds like a great way to start with very little capital.
It is, and that's why it's popular with beginners. It takes serious marketing and deal-finding skills, but you avoid all the rehab costs, the loan fees, the contractors. But you have to remember, it's a job. It's not an asset.
Yeah.
You only get paid when you find and close a deal.
Since this is all about the beginner, limiting risk has to be the top priority. Those first few deals are where you make your mistakes. So what are the recommended low-risk strategies to start with?
The sources are pretty unanimous on two main paths. The first is starting with a single-family home or a small multifamily unit.
And the logic there is all about the exit strategy, right?
It's all about the exit strategy. That type of property, a small 2 to 4 unit place, appeals to the single largest group of buyers out there. First-time home buyers, owner-occupiers. So if you mess up your numbers or you decide investing just isn't for you, you have a really easy way out. You can sell it quickly, probably break even or take a small loss. That high demand creates a safety net under the price. It limits a catastrophic loss.
Okay, and the second recommendation, which seems to be the gold standard for beginners, is house hacking.
House hacking is, without a doubt, the ultimate low-risk path. You're turning your personal residence into an asset that generates wealth. The concept is you buy a duplex, triplex, or a fourplex, and you live in one of the units yourself. And the huge advantage comes from the financing.
Which is what? Exactly.
Because you're living there, you're an owner-occupant, so you qualify for these incredible low down payment loans. You can get an FHA loan for 3.5% down, or a conventional loan for 5% down. That is a massive, massive advantage compared to the 20 or 30% you'd need for a pure investment property.
That almost sounds too good to be true. What are the downsides? I mean, you're living right next door to your tenants. That seems
Oh.
complicated.
It is, and that's the trade-off. You learn how to be a landlord firsthand, for better or worse. But the rent you collect from the other units can subsidize or, in many cases, completely cover your entire mortgage payment. So you're essentially living for free. That frees up all the money you would spend on housing, and you can save it for your next investment. But you have to be disciplined. It has to be a professional relationship. Written leases, proper screening, clear boundaries.
Okay, let's get into the weeds here. Let's walk through that aggressive strategy you mentioned for someone who's done the work and saved up, say, $50,000 in cash.
This is where you see strategic debt in action. If you've got that $50,000, you need to maximize your doors, maximize your potential rent. So you go straight for the fourplex if you can. Let's use that $900,000 fourplex example.
Okay, run the numbers for us. How does $50,000 buy a $900,000 property?
You're house hacking, remember. So you use that 5% down conventional loan for owner occupants. 5% of $900,000 is $45,000. That leaves you with $5,000 for closing costs and reserves. Your loan is $855,000. Now here's the key part. Right now, interest rates might be high, let's say 7%. That means your mortgage payment is going to be big, your cash flow might be zero, it might even be slightly negative.
But wait, if I'm just breaking even or losing a little money, isn't that a huge risk? And if I wait for rates to drop, my $50,000 is just sitting there shrinking.
That's the critical question, isn't it? It's only a risk if you don't have a plan. But the plan here is twofold. First, you are immediately gaining appreciation on a $900,000 asset, and you're getting huge tax write-offs. People always forget about those. Second, you're locking in the purchase price today. The plan is to refinance later. When rates are forecast to drop in a year or two, you refinance to a much lower payment. And suddenly, that break-even property is a strong cash-flowing machine.
So the big takeaway is that owning something now, even if you just break even for a bit, is infinitely better than owning nothing. You put your money to work immediately, knowing you can optimize the financing down the road.
Exactly. You are forcing your capital to grow instead of letting it shrink. The appreciation starts on day one.
And that makes saving for the next deal, the repeat part of that BRRR method we'll talk about, so much faster because you're already in the game.
Right.
Speaking of financing, that $50,000 example really shows how one loan product can be a launch pad. But as you grow, you need more tools in your belt, right? Standard conventional loan isn't always going to work.
Absolutely not. A savvy investor has a whole toolkit of financing options. They're all tools for different jobs.
Let's break down the most useful ones. Let's start with those government-backed loans that give you so much leverage.
Okay, so we mentioned the FHA loan, which is 3.5% down for owner-occupied properties up to 4 units. But a really powerful version of this is the 203K loan. A lot of people call it the rehab loan. This thing is a game changer because it lets you finance not just the purchase price, but also the cost of repairs, all into one loan.
Hold on, that sounds like a bureaucratic nightmare. I'm picturing the bank having to approve every single paint chip.
It definitely adds a layer of complexity, but the benefit is huge. The 203K loan requires 2 appraisals, one as is, and one for the estimated after repair value. And the financing is based on the ARV, not the current rundown condition of the property. So if you buy a $100,000 duplex that needs 12,000 repairs, you could finance the full 112,000, and you still only have to put down 3.5% of that. Your total cash out of pocket is less than $4,000. It's incredible leverage.
Okay, but what's the catch?
The catch is you have to use FHA-approved contractors, and the rehab money is held in escrow. It's only released after inspections are passed, which ensures the work actually gets done right.
Okay, so moving away from owner-occupied loans, what if I already own my home and I've built up a lot of equity? How do I get that money out to invest without selling?
That's where home equity loans and ELO-Lex home equity lines of credit become your secret weapon. These let you borrow against the equity in your primary home, often up to 80 or 90% of its value. And this is huge because the loan is secured by your stable primary residence, not the beat-up investment property you're trying to buy.
So I could pull, say, $80,000 out of my home with the HELOC and use that cash to buy a fixer-upper. What's the advantage of that versus just getting a mortgage on the new property?
Speed and power. With that HELOC cash, you can make an all-cash offer. Cash offers close way faster. You skip all the appraisal and financing contingencies, and sellers love them. They'll often accept a slightly lower cash offer over a higher financed one, just for the certainty. It lets you snap up deals others can't touch. Plus, the interest rate is usually way lower than other types of short-term loans.
What about when you start to scale up? You hit the limit on conventional loans, maybe you have 4 or 5 properties, or you're self-employed and the banks don't like your paperwork.
That's when you have to start networking to find portfolio lenders. These are usually local banks or credit unions that lend their own money. They don't sell their loans to Fannie Mae or Freddie Mac. And because it's their money, they can make their own rules. They can be more flexible. They might understand a self-employed person's cash flow better, or they might let you own more than the typical 10 property limit. You'll probably pay a slightly higher interest rate, but you get way more flexibility.
And when you go even bigger, say a 5-unit apartment building, the whole game changes again.
Yeah, then you're in the world of commercial loans. For 5 or more residential units or any non-residential property, the bank cares less about your personal income. They're almost exclusively focused on the property's income. They look at something called the debt service coverage ratio, or DSCR. Basically, does the property's own cash flow cover the loan payment with a healthy margin left over? The asset itself has to pay for the debt.
Okay, and what about those high-cost, short-term loans for flipping? I hear about hard money and private money. What's the difference?
Hard money comes from professional regulated lenders. It's short-term, maybe 6 to 18 months, and it's expensive. Think 8 to 15% interest plus big upfront fees. It's based almost entirely on the property's value, not your credit score. You use it when you need to close fast on a distressed property that a normal bank wouldn't touch.
And private money?
Private money is functionally similar, but it comes from individuals, friends, family, other investors who are looking for a good return. The terms are usually a lot more negotiable, and there are fewer fees. The key with both of them, though, is you absolutely must have a clear exit strategy. You're either selling the flip in 6 months or refinancing into a long-term loan right after the rehab. You do not want to be holding a 12% loan for years.
Let's circle back to leverage for a second. If I have $100,000 in cash, why not just buy a cheap house outright? No debt, no risk.
That's a great question, and it gets to the heart of compounding. The sources lay this out really clearly. If you take that $100,000 and buy one house for cash, and it makes you, say, $1,000 a month in cash flow, that's a 12% annual return. Not bad.
Okay, but if I use that same $100,000,
If you use that same $100,000 as a 20% down payment on 5 similar houses, each with an $80,000 mortgage, yeah, your cash flow per house is going to be lower after you pay the mortgage, maybe only $300 a house. But your total cash flow is now $1,500 a month.
whoa, so I'm making $18,000 a year, an 18% return on my original $100,000. I've earned 50% more just by using the bank's money.
That's it. That is the fundamental difference between a saver and an investor. An investor uses the maximum amount of other people's money OPM to get a higher return on their own limited cash.
And this idea leads us right to the engine of rapid growth, the BRRR method: buy, rehab, rent, refinance, repeat.
This is probably the single most powerful strategy for a beginner to build a portfolio quickly without having to constantly save up new down payments.
Walk us through the refinance step, because that's the magic part, right? That's where you pull the value out.
It all hinges on forced appreciation. You buy an old beat-up property at a discount. That's the buy. Then you immediately add a ton of value through renovations. That's the rehab. Once it's fixed up and you have a tenant paying rent, the rent step, you call the bank. They send an appraiser who sees that the property is now worth way more than you have into it. You then do a cash-out refinance based on that new higher value.
And the cash you pull out is tax-free.
Exactly. Because it's a loan, not income. That cash you extract, the difference between the new loan amount and what you owed on the old loan, is then immediately used as the down payment on the next property. That's the repeat.
The sources claim a focused investor can turn $70,000 into 4 properties in under 2 years just by recycling that same capital over and over. What's the biggest mistake people make here?
The biggest trap is over-improving the property. Putting in granite countertops when the neighborhood only supports laminate. Your renovations have to be laser-focused on what will increase the rent and the appraised value. Advanced investors take this even further by focusing on development things like adding a 3rd unit to a duplex or converting an attic into a bedroom. That's how you really supercharge the value beyond just what the market is doing naturally.
Whether you're flipping or using the BRRRR method, you can't do it alone. The sources are so clear that failure often comes from poor planning, and that includes not having the right team.
You absolutely have to assemble a team of pros. Your time is worth more than what it costs to hire a plumber. You should be finding the next deal, not fixing a leaky toilet. And that team starts with the single most important person for a beginner, the investor-friendly real estate agent.
Why is the agent so critical? I mean, beyond just finding properties and opening doors.
Their most important job is helping you accurately determine the after-repair value, the ARV. A regular agent focuses on curb appeal. An investor-friendly agent is looking at price per square foot, the condition of the big-ticket items like the roof and HVAC, and most importantly, what the property can realistically rent for. They have the data and the skills to protect you from overpaying. And in this market, if you get the ARV wrong, you've lost money before you even start.
Okay, who else is on that must-have list? Let's talk about the money people.
You need a creative mortgage broker who knows all the investor-focused loan products we've been talking about. And crucially, you need a CPA or accountant who specializes in real estate.
Why not just use TurboTax? Why pay for a specialist?
Because a good real estate CPA will save you way more than they cost. They understand the nuances of depreciation, how you can get a tax deduction for the wear and tear on a building, even while it's going up in value. They know how to structure your assets in LLCs for protection, how to deduct every possible expense. You'll lose thousands if you get this stuff wrong.
Yeah, and for legal protection.
A good real estate attorney. You need them for reviewing contracts and, most importantly, setting up your legal structures like an LLC or a trust. This is what separates your personal assets from your business assets. If a tenant sues, you want them suing the LLC, not you personally.
And finally, the person who can literally make or break your budget and your timeline, the contractor.
Your contractor has to be licensed, bonded, and insured. No exceptions. And the sources all warn against this false economy of trying to do all the work yourself to save a few bucks. That almost always leads to huge delays, amateur work that has to be redone, and it sucks up all your time that should be spent finding the next deal. Get 3 bids, check references, and hire a pro.
So you've got the team in place. Now for the hardest part, actually finding a good deal. The sources say you have to be ready to play a numbers game.
You have to think like a factory. In a competitive market, you might have to write 20 or 30 offers just to get 2 of them accepted. High volume is key. And you have to use strategies that get you away from the competition.
Let's start with the properties that are already on the market. How do you find an edge there using the MLS?
Right now, with more inventory on the market, you have an advantage. You want to target properties that are stale. Anything that's been sitting on the market for 45 days or more, or listings that expired without selling, those sellers are usually getting very motivated. Have your agent set up an automated search for those and just consistently send out lowball offers. Persistence pays off.
You also mentioned targeting a specific price range for safety.
Yes. Always try to buy at or below the median home price in your market. This gives you a huge safety net. Those properties have the lowest risk of price drops in a downturn, and there's always a massive pool of both renters and first-time buyers who want them. It's where you find the most reliable deals.
Now for the really powerful stuff, off-market sourcing. How do you find the deals that nobody else even knows about?
You have to be willing to do the work that others won't. One classic method is targeting probate leads. These are properties where the owner has passed away. They can be complicated. Sometimes you have to deal with multiple heirs who can't agree, but there's way less competition.
And you mentioned a really clever tactic using return-to-sender lists.
This is a golden nugget. Think about it. Big investors send out thousands of pieces of direct mail to lists of, say, absentee owners. A bunch of that mail always comes back undeliverable because the owner's contact info is old. The big guys just throw that list away. You can buy that list of undeliverables for cheap and then hire a virtual assistant or use a service to do what's called skip tracing.
What is skip tracing?
It's just a fancy term for tracking down the owner's current contact information, their cell phone number, their new address. Now you can reach motivated sellers that none of your competition has been able to contact. You're fishing in a pond all by yourself. It dramatically increases your chance of finding a great deal.
This all comes back to that old saying, you make your money when you buy. It's about finding that hidden value that everyone else overlooked.
And to really maximize your line, after repair value, you need to look for specific conversion opportunities. I'm talking about houses that have a weird layout, like a huge 2,000 square foot house that's only a 2-bedroom, 1-bath.
That just screams potential.
It's an immediate profitable opportunity. You can convert that space, maybe wall off a dining room to create a 3rd bedroom, add a 2nd bathroom. That directly boosts the ARV in what you can get in rent.
And you're also looking for unfinished space that's easy to convert?
Yes. Spaces that are already under the main roof line but aren't counted as living space garages, sunrooms, unfinished basements. Converting those into heated, finished square footage is one of the cheapest ways to add massive value to a property without the cost of building a whole new addition.
This has been an incredibly dense deep dive. We started with that fundamental mindset shift, seeing debt as a tool, not a burden, and then we built a roadmap starting with low-risk strategies like house hacking.
We detailed the high-leverage engines like the BRRRR method for recycling capital, and we went through the absolute necessity of building a professional team to protect you and save you time.
I think the biggest takeaway here is the power of consistency and intention. Ordinary people become extraordinary investors not by hitting one home run, but by staying consistent for decades. By following a clear strategy and not giving in to FOMO or chasing hot trends. It's a marathon, not a sprint.
And that leads to one final provocative thought for you to consider. If you choose to spend your own time doing things like swinging a hammer, managing tenants, or even just mowing the lawn on your rental property, you are operating with what our sources call poor mindset energy. You're trading your most valuable asset, your time, for what is essentially $20 an hour labor.
True wealth acceleration really happens when the investor focuses only on the highest value activities. That's strategy, that's research, that's deal analysis, and raising capital. You outsource everything else. You have to recognize that your time is wealth, and you have to leverage it just as aggressively as you leverage your money.
Exactly. Invest your time where you create the most value and pay other people to do the rest. If you don't value your time, why would anybody else?
A perfect thought to end on. Thank you for joining us for this deep dive into building your real estate foundation. We really hope this gives you the roadmap to move from just thinking about it to actually doing it.
Until next time, keep analyzing, keep planning, and keep that currency moving forward.
If you got value from this podcast, hit the like and subscribe, and keep building your real estate foundation brick by brick. This podcast was sponsored by Riverside-Realty.com.